Okay, let's record some transactions. We've got 8 things to record. We're going to total them all up and come up with hopefully an asset, liability, owner's equity situation that's in balance. Also, I've got a note over here saying the homework version will ask for subtotals every 2 transactions. So I'm not going to do subtotals, but you'll have to. So let's take a look and see what we got here. First of all, notice that we've got assets equal liabilities plus equity, and we got it broken down into balance sheet accounts, which would be cash, supplies, equipment, accounts payable, notes payable, the J. Scott capital account, and the J. Scott withdrawing account. Those would be all the things you'd see on a balance sheet. We've also got some equity accounts here that are going to be on the income statement, which would be revenues, expenses, and net income is not an account. It is not an account. It's just the result of revenues minus expenses. So let's start with our first transaction and see how we're going to put it on this grid. J. Scott, the owner, contributed $20,000 cash to start a business. Well, what's going to happen here is, from the business's point of view, cash is going to go up $20,000, and that will be on the asset side. And we'll also have an increase to the J. Scott capital account, and that will keep us in balance, and it'll show that both sides went up. Now, I've put this on here to make sure that you understand that when you start a business and you have an increase in cash and an increase in capital, that transaction does not, I repeat, does not produce any revenue. So there's no revenue involved in this, because in order to have revenue, you got to have a customer, and you got to have a customer that you're selling a product or a service to. So when you start a business by putting cash into a business, that has no customers involved and therefore no revenue. It also has no expenses, and when you have no revenue, no expenses, you have no income. Okay, so just keep that in mind. I'll be reminding you of this throughout these transactions. Second transaction, purchase supplies, and we paid $1,000 cash. And anytime in these transactions where it says we pay $1,000 cash, you have to assume, at least I'm going to make you assume, that the cash is always the cash from the business, and like from this $20,000, unless we're told otherwise. So we're going to assume it's from the business's cash. So purchase supplies, paying cash of $1,000, so cash is going to go down and supplies are going to go up $1,000. And notice that the assets basically stayed the same. We went down. Let's see, where's my cursor at here? I don't see it. I guess I'm going too fast. Oh, there it is. Okay. The cash account went down, which is an asset, but supplies, which is an asset, went up. Now, supplies in this case are an asset because there's something that has future value, and until we know the difference, they're going to be something that the business is going to use as a resource. Therefore, we're going to keep it as an asset until we use it up, and then when we use it up, we'll expense it. But that's not going to be in this problem. All right, so let's go to the third transaction. Oh, also, before we go to the third transaction, this buying the supplies is not revenue. It's not an expense. Therefore, it's not anything connected with net income. It's just trading one asset, supplies, for cash, which is another type of asset. Transaction 3, excuse me, we purchased equipment for $15,000 cash. So cash is going to go down $15,000, and equipment is going to go up $15,000. And again, all we did was trade one asset, which was equipment, for another asset, which was cash, and assets didn't change. And if assets don't change, that means that liabilities don't change, and neither does owner's equity. So again, buying equipment has no effect on revenue, no effect on expenses, and no effect on net income. Number 4, purchase supplies of $200 and equipment of $1,000 on account. When it's on account, that means we have created a liability. We've charged it. We've put it on a credit card. We've took out a loan for it. Now, when you do this, what happens is supplies go up $200, equipment goes up $1,000, and the total goes as an increase to a liability. In this case, we're going to say accounts payable. It could have been notes payable, but the word account up here means it's something that is not a note, not going to draw interest, and something we expect to pay off within 30 days usually. So asset side went up 1,200, the liability side went up 1,200, and we're in balance. And again, buying equipment this way and supplies this way absolutely positively are not going to be anything that's a revenue, not an expense, and therefore not net income. Number 5. We borrowed $4,000 from First American Bank. So when you borrow money from the bank, cash goes up $4,000. And in this case, the bank wants interest. So we're going to say this is going to be an increase to notes payable. And so assets went up 4,000, liabilities went up 4,000, so both sides stayed in balance. There's nothing going to happen to the equity side, and when you borrow money, that does not create any kind of revenue. Remember, to have revenue, you got to have a customer, and you got to sell that customer a product or service. So no revenues, no expenses, and no net income. Number 6, we rendered consulting services and we received $3,000 cash. This is why we're in business. You know, you go into business to make some money, and you got to have customers and so forth and so on. And this is what we did. We have a customer now that we've done some consulting services for, and they immediately paid us $3,000 cash. So cash goes up 3,000, and on over here under the equity account called revenue, we're going to have a plus 3,000 there also. Let's see. Now that transaction did not create any expenses, and right now, at this point in time, we have $3,000 worth of revenue. Where's my cursor? There it is. $3,000 worth of revenue, no expenses, so therefore we have $3,000 worth of income right now. All right, number 7. We paid salaries of $800 to employees. So when you pay salaries, the word paid means we wrote out a check. We spent some cash. So therefore, we're going to reduce cash by $800, and we're going to reduce the owner's equity section under expenses by, no revenues by the way, by $800. So that $800 reduction under the expense column is going to translate into an $800 decrease in net income. And right now, if we were to ask the question, how much is net income? Well, right now it would be the $3,000 worth of revenue. Let's see, where's that cursor is at? Where is it at? Where is it? Anyway, $3,000 worth of net income on that transaction number 6. And it would be $800 worth of expenses. So right now we'd have a $2,200 net income right now, which is this $3,000 minus $800. So let's look at transaction 8. Transaction 8 says that J. Scott withdrew $500 from the business for personal use. This is not an expense of the business. This is just the opposite of what transaction 1 was. In transaction 1, the owner put money into the business, so cash went up and the capital account went up. This is just the opposite. Cash is going to go down by $500, and we could put this in the capital account as a reduction, but it's really better to keep track of it separately in a separate account called withdrawals, owner's withdrawals. And so we're going to reduce owner's equity by putting a minus 500 there in the J. Scott withdrawal account. Now, we've done all 8 transactions. Now it's time to total them up. So you'll have to trust my math here. So all the cash is combined, and we're going to get, oh, I'm sorry, hang on. We've got to go over here and say that this transaction, this number 8, which was a withdrawal of funds for personal use, that's definitely not a revenue. It's absolutely not an expense. So therefore, this transaction had no effect on the income statement. Now it's time to add all these account totals up here on the bottom. So our cash account now has a total of, right now, of $9,700. Our supplies, $1,200. Our equipment has got a total of $16,000. Accounts payable is $1,200. Notes payable is $4,000. The capital account is going to come down here at 20,000. Withdrawals will be a minus 500. Revenues would be 3,000. Expenses will be a minus 800. Net income, like I said, since we didn't have any of the transactions, is 3,000 minus 800, or $2,200. Okay. Now, to make sure that our accounting equation is still in balance, we're going to do the following, I hope. Let's see. We're going to add up all the assets, which were cash, supplies, equipment, and those three add up to 26.9 were the assets. We're going to add up the liabilities, which would be accounts payable and notes payable, and that's going to give us total liabilities of 5,200. And we're going to also add up the capital account, the owner's equity accounts, which would be, there's only 4 of them. There's the capital account, there's the withdrawing account, there's the revenue account, and there's the expense account. Again, net income is not an account, it's just the result of revenues minus expenses. So when you combine capital and withdrawals and revenues and expenses, you're going to get equity of well, where is it here? Oh, I'm adding all those up, put them in red. When I add all 4 of those together, the ones in red, I end up with 21.7. So 5,200 plus 21.7 is going to, that's the right side, and that's going to equal, and should equal, the asset side, which is 26.9. And I believe we're done.